Growth stocks can be very risky, riskier than most other stocks because it's very, very hard to grow very fast. But when you can find a growth stock like Masonite International that's growing earnings at over 28% a year, remembering that the average company grows between 6 and 8%, and you can buy it at a significantly low value. Here you've got an 8.8% PE. The rates of return from taking the risk of investing in something like this is extraordinary. Even if the stock only traded at its normal PE ratio of 18 times earnings and earned the earnings that the analysts are expecting, you would almost triple your money in just roughly a 1.5 to 1 3/4 year time frame, averaging 79% annualized. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by you as Mr. Valuation. I'm doing a second subscriber request video this week. Part of it is penance because I missed Tuesday. I was on vacation, as most of you know from my last video. But the point is, I'm asked this question quite often. I talk about dividend growth stocks primarily on this channel. It's my passion now. I like the idea with the market as heavily overvalued as it is today. I really like the idea of the safety and also the benefit that dividend-paying stocks, especially high-quality dividend-paying stocks, offer. But growth is also a very attractive way to invest money. And now I did have a subscriber ask me to provide an article on some growth stocks that were attractively valued. So I created a portfolio here, and I call it Growth and Value, because finding stocks that grow faster than the average stocks can be very attractive long-term investments, but they can also be riskier. And one way to mitigate that risk is to buy them when they're undervalued. Okay, so I'm going to go through, I put together 15 stocks actually on this list that I think are attractively valued but also growing faster than the average stock. Now, these are pre-research. As I said, I'm really primarily focused on dividend-paying stocks today. So these are all stocks that I'm throwing out there for you to research. I'm not suggesting that they all are excellent buys. I'm suggesting that they are riskier than most, but I'm also suggesting that if you were able to do the research and determine that the risk is worth the potential rate of return, then, invest your money and go ahead and take that risk. But I do recommend that you do your research first. So I'm going to go through these one at a time in alphabetical order to start out and, just basically point out some attributes of why I call these a growth stock. Now, the average company grows at about 6 to 8% a year. Here you have Aire Lease Corporation. And by the way, I'm going to go through with this first one here how I would go about researching these stocks. I would, of course, use FastGraphs, and I would look at, I forget about price for a moment, but I'd look at the company's record. And you can see here that the company has a very good record, growing earnings at about 11% a year since 2019. If I go long-term and shorten that to about 12 years, they've grown earnings at over 15% a year. Coming out of COVID, they did have a couple of bad years, but that was kind of an extraordinary circumstance. The earnings are expected to grow for 2022 at 30%, for 2023 at 33%, and then slow down to 14%. So that's tremendous growth. You can buy the stock today at a 11 PE ratio, roughly, half or almost a third of what the potential growth is. So if you're looking at it from the standpoint of the stock trading back at the normal PE that the market likes to trade this at, you're looking at a 32% annualized rate of return out through the end of 2024. And that's where the risk, the reward for taking the risk can really be achieved. And that's only trading at its normal PE. If I look at forecasting and this stock were to grow at 24.5% going forward over the next 2.5, 2 3/4 years, like analysts project, and it traded at a 24 multiple, at that 24.52 or growth stock multiple, then the annualized rate of return out there to the end of 2024 would be 68%, 67.79%, rounded to 68% a year. So that's really tremendous. So the point is, the risk of investing in these stocks can be worth it, especially if you mitigate that risk by buying them at attractive value. Now, again, I'm going to reiterate, I have not researched any of these stocks deeply. So what I would suggest is I just show you a process that I would use. If you're a FastGraph subscriber, the first thing I would suggest is going into the company's website, okay, and looking at what the company does. And Aire Lease Corporation is a leading aircraft leasing company. All right, so that gives you some insights into the company. So you can, spend some time learning about that. You can also go into outside research like companies like Seeking Alpha, the Wall Street Journal. I use Morningstar as Zacks, and they'll have some information on this, but probably not a lot on some of these smaller growth stocks. This is a $4.8 billion company. Total enterprise value is $20 billion, and it does have a lot of debt, and that can really affect the equity value of the stock. But in today's market with low debt, keep in mind this company's buying airplanes, multi-million-dollar aircraft, and it makes sense to borrow the money to buy those. So anyway, there's the first one, Aire Lease. The next one would be Ameriprise. This is the spinoff from American Express, as many of you might know. It's an asset management and custody company. It's grown earnings at over 16% a year. It's forecast to grow earnings at about 13.5%. Now, I'd like to see 15% or better growth for growth stocks. But again, if I can get it with a margin of safety, then I'm willing to do that because my rate of return potential is very, very high. In the double digit, the closer time is going to be higher annualized rates of return because of the low time frame. But as you go out, it settles into about a 20% plus annualized rate of return. I think Ameriprise is very attractive. This is one that I do own and that I have researched. I think it's attractively valued here, although not necessarily a screaming bargain like it was during COVID or back here in 2019. So I do want to make that clear. The next company I'm going to look at is Borg Warner. I've been actually asked repeatedly to cover this company. It's a little more cyclical. It's an auto parts and equipment company than a lot of growth stocks, but it does have good growth, depending on what time frame you measure, and what period of the cycle we're in. You can end up getting a lot different growth rates from this company. Forecast growth right now is forecast to grow at about 12.6%. But once again, you've got such a low valuation on the stock right now, that could translate into, 35 to 40% rates of returns out there. It could be 57% rates of return closer. And if it just goes back to its normal valuation, like you can see it was trading at for most of 2021, you'd get, a 57% rate of return. You could double your money this year. The stock has the potential to do that by simply moving back into alignment with fair value. That's what the advantage of buying these growth stocks at value can really be. The next one is Cigna, another pretty well-known company, a healthcare services company. You can buy it at a reasonable price. It's been a double-digit grower, forecast to continue growing at double digits, about 10.8%. Gives you the opportunity to make really nice rates of return. You can buy these stocks cheap enough today that it makes the risk of investing in them a little more palatable. Now, Cigna is also turning into a dividend-paying stock, but it's too soon to really be able to project how well that company might perform as a dividend growth stock. But, time will tell, so we'll be able to know that as we go forward. The next one I will look at is Masonite International Door. You can see the company didn't earn any money at all in the early years of it as a public company. But then starting in 2015, it started to really generate some good returns. Now I'm going to call out all those numbers. It's been a 20% grower for the last several years, even as high as a 28% grower if you go back, all the way to the beginning of 2016. The company is forecast to grow at over 16%. I would call this a true growth stock. And you can buy it at a PE ratio just slightly higher than half its growth rate, which gives you the opportunity to generate really superior rates of return over the next couple of years. So this company is known for their doors. Again, you can go into the company's website. That's always a good place to start out. And you can basically, learn about what the company does, what kind of products they make, as well as go into their financials and everything else. And I encourage you all to do that with any and all of these companies. The next is Forestar Group. It's a real estate development company. This one is interesting. Real estate development right now is hot, as many of you know. The company is forecast to grow pretty fast. Now, if you look at what it's done in the last several years, it's been growing at an incredible 44%. Now, the company, as I understand it, did miss some earnings estimates. Here recently, just what little bit of research I've done, So, the reality of it is, the stock is very inexpensive right now. It's very cheap. It's only trading at 5.5 times earnings, but the fundamental growth of this company going forward is expected to be very strong. Longer term, it's expected to grow at over 20% a year, which is comprised of 57, almost 58% this year, which, ends in September, I do want you to know. So they have a September fiscal year end, followed by 18% and then followed by approximately 12%. So if you're looking at this stock trading at even a normal multiple, you've got incredible opportunities here, assuming the stock does revert to its, more reasonable valuation based on its growth rate. That's really the key here with any of these stocks. But again, you can go into the company's website as a starting place. You can also go to other sources of research, but you can go into the company's website, go into their investor relations. You can look at their financial information, news items, events and presentations is a place I always like to go where you can learn more about the company. So my point is these companies I think are worthy of spending some time on research if you're looking for growth. Graphic Packaging Holding Company is another one that's had really spectacular growth. The market does tend to price it at around 17 times earnings. But even at that today, when it's currently trading at a 15 multiple, you do have an opportunity here to generate, incredible rates of return over the next couple of years if this just moves back to its, reversion to the mean. If you're looking at this stock from the standpoint of moving back to its earnings growth rate, which would be a PE of about 19, you've got 35%, annual rates of return out for the next 2.5 years potential. Again, you'd want to go into the company's website to start and learn about what the company does, what kind of products they make, and then study their financials and so on, which you can do that through the Fast Graph. Remember, I'm just putting these out as research candidates here. I was asked, do I have a list of growth stocks now? I do have a much larger list of growth stocks. I've eliminated some of the obvious ones like Facebook and so on, or Meta platforms now. I'm trying to give you some growth stocks here you might not have looked at before. The next one is Herbalife. Herbalife is much maligned. It's a multi-level marketing company, at its core. It does have a really good long-term record. They have eliminated their dividend years ago. The company is expected to continue growing at over 12% a year. You can buy it at a PE of about 6 times earnings, which is, incredibly inexpensive. Again, if the stock reverted back to a normal valuation, in this case, we're only talking about a PE of 15, not going back to some high growth PE. Your rates of return potential out there are really staggering in the 30, 40, 50% range, the longer out you go. So Herbalife is one. If you're willing to take the risk, you could take a look at. Rocky Brands is somewhat cyclical. It has been growing very strong for the last several years. I think that's what, I'm focused on here at over 30% a year. It's forecast to continue to grow at over 20% a year. Even if you look at this with its normal multiple of about 13 times earnings, it's currently trading at 8 times earnings. You've got an opportunity here to make, 40 and 50% rates of return and even double your money in the next year. It's possible if these stocks just simply revert back to that normal valuation, and you can see it's traded at that or higher for many, many times over the years. The next one is Synaptics. Synaptics is a semiconductor company. Its growth rate is expected to slow down a little bit to about 16% a year, but you can buy it today at a blended PE of 14 and earnings yield over 7%. And that gives you the opportunity to make nice double-digit rates of return out for the next couple of years. Again, you can always go into the company's website and, learn more about the stock, what it does, what its businesses are, what its financials look like. You can go look at presentations. You can see the markets they serve and so on. And it's always important to do that kind of work if you're going to, take a chance looking at, at some of these companies here. But you can see it's a little bit cyclical, but it does have a really strong long-term growth record. The next one is Tempur-Pedic Sleep. This is a mattress company, bedding company, home furnishings is what the sub-industry classification is. The company's forecast to grow at about 12% a year, but you can buy it at an 8 PE. In this overheated market, these are extremely low valuations. It does pay a modest dividend, does give you the opportunity to generate really good rates of return. And eventually, and again, you'd want to go in and research. This is one that most of you would know. What I'm really looking at here is the margin of safety and the low valuation that you can buy this company at. And if it goes back to a normal 18 PE ratio, you've got really incredible rate of return potential to make on the stock. That's Tempur-Pedic Sleep. TriState Capital Holding is a regional bank, a very fast-growing regional bank. I'm not sure what its market is right now. Again, I have not researched these stocks. I'm just simply trying to give you an opportunity to see value and growth combined. And these companies, really offer that potential. But again, you can go into the company's website and learn all about it. The next one is Ultra Clean Holdings, semiconductor equipment. They really work on cleaning the semiconductor plants and manufacturers and providing technology that allows them to do that. They support the life cycle of chip manufacturing as they bill it, enabling technology for 30 years. Again, you can go in here and learn all about the company and what they do. And the reality is they're expected, especially with chip shortages, to grow very nicely over the next couple of years at over almost 14% a year is the consensus, giving you incredible rates of return. Even at the normal PE of only 12 times earnings, this would give you, very high rates of return. These are growth stocks. These aren't for the real ultra-conservative or skittish, but they're, really interesting looking. Here's Universal Logistics Holding, another one that's been very cyclical, but has been growing very fast here in recent years. If you're looking at the future, it's expected to grow about 16% a year. Combined at six times earnings, incredible buy, giving you the potential to make just absolutely astonishing rates of return, even if it only trades at a low PE ratio of under 14 times earnings, which you can see it's done that, numerous times, even when the earnings weren't as good as they currently are. And then last but not least, you've got United Rentals. Many of you are familiar with this company or would be familiar with this company. They rent, all types of equipment for all types of construction and different kind of work. Again, you can go in there and learn about them, learn about what their numbers are. You can see the earnings growth has been substantial. It's been averaging over 14% a year, but if I shorten the time frame, it's been since 2000, well, that's maybe a little aggressive. Let me shorten a little more. It's been growing over 20% a year. It normally trades at around 12 times earnings. It's currently trading a little higher than that. But you can see that the company has generated very strong performance when you buy the company at a reasonable valuation and hold it for the long term. And that's really a key. So there you have it. You have this list of growth stocks, these 16 growth stocks that are potentially very attractive that you can research and look into for yourself if you're a growth stock investor, if you're looking to, accumulate a lot of money. In today's overvalued market, most of them are real cheap. They offer a lot of, safety, in my opinion, through the margin of safety concept. They are growth stocks. They do have, fundamental values that are significantly understated relative to their value. So here's just some, if you're looking for growth, these are some names you might want to check out a little further. Anyway, this has been Chuck Carnival, a.k.a. Mr. Valuation, thanking you once again. This was a subscriber request. When I do subscriber requests, please know that it does not mean that I'm recommending these stocks. What I'm trying to do is find interesting looking stocks based on what I see on Fast Graphs for you to go ahead and research and learn more about yourself. If you like this video, give me a like, subscribe to the channel, and you also might want to take a look at Fast Graphs. It's one of the most efficient research tools you can find. Anyway, thanks you all for watching.